Heidi ho, everyone, and welcome aboard. It's wonderful to have your company this Sunday, the 30th of, October. I think we said December. Can't come fast enough. Not. We're welcome, as usual, to our weekly wander around the world as we check to see what's on the minds of the actions of stable traders, I suppose. Stable being quite pertinent here in Australia at the moment, as the biggest horse race in this country is about to take place in a couple of days' time. Tonight, however, we're off to New Zealand, who keeps winning the Melbourne Cup, Singapore, South Africa. Where else are we going? Salvador. Then we're coming back through Singapore and back to Australia. But first up, we will go across the ditch and have a chat to our good friend who I haven't seen for ages. It's wonderful to see him, smiling face from across the ditch there in Auckland, New Zealand. Okay, Jules. I know he's there. Maybe we've lost Julian.
He looks stuck.
Julian, are you there?
Yes, Geoff, I am here.
I can't hear you, mate. You're
struggling a faction.
There you
go. Okay, can you hear me now?
Yes, mate, I can. All good. Are you good?
Brilliant.
Oh, I'm not sure if Julian can hear me.
Okay.
Can you hear me, Jules?
Let me just find my thing to.
I think we're having issues with Julian's connection, or is it just me? I think everything else seems to be okay. We'll just wait a second until that comes good. If it doesn't come good, we'll just move on and hopefully hook up with Julian in a bit. No, mate, you're very, very, very faint in the background and the connection is very, very poor. Very unstable. Maybe it's windy in Auckland, I don't know. What we will do, because we've got Lexi in the room, is we'll just move straight on. Hopefully Julian can fix that issue and we'll come back to him shortly. I don't know if he can hear me or not, but hopefully that's the case. So let's check in with the fundamental part of what's going on around the world and say a very, very good evening in Singapore to Alexis. Lexi, how you doing?
Hi, Geoff. Hello,
hello.
Well? Yes, doing all right.
Look at your smiling face. You're beaming. Absolutely. You're not pregnant, are you?
No.
No, I didn't think so. Just thought I'd check.
Yeah. All right.
What's the world of fundamentals telling us at the moment, mate?
Well, it's very, I would say the fundamentals is in a very interesting place right now. We are, I think, what I would call it in the era of unexpected, right? There's a lot of things that we didn't or the market didn't expect. If you look at it in the last maybe like 5 years, a lot of market overextensions. You can actually see a lot of overextensions happening in a lot of the currency indexes around the world. So the question is, we have a unique situation of overextension of currencies and inflation. I'm going to use the word overextended as well, to just elaborate the fact that I think inflation in a lot of the developed countries are at a high where it's never been for a very long time, right? So we are in a new regime of inflation and overextension in terms of currencies. So I guess that makes it interesting for currencies because I'm pretty sure the next question will be, and I'll probably also ask Julian that question, when will things start reversing? When do the reversal traders start to make their money, right? So that's probably one big question that I'm sure everybody is kind of waiting for. Everybody's waiting for that wonderful reversal trade that will make us that huge early entry, which gets in on, whatever we're trading in. So I think that's a curiosity which I have, but I'm just going to borrow Lloyd's indicator list to just go through this overextension. So in terms of overextension, I think it's a really common technical idea that, overextensions happen when it's past all support and resistance levels. So I'm on a monthly chart here. Dollar index, pretty okay. I mean, it's somewhere in the middle-ish, so not too bad. But for the rest of the world currencies, look at the Canadian dollar. It's so close to the bottom, reaching its overextension. British pound minus, if you minus that very first 2007, I'm assuming this is the financial crisis candle or something. It's also, at its lowest point where it's never been in the last, almost 15, 20 years. You have the Australia all at the bottom. You have the Swiss all the way nearing some sort. I wouldn't. This area is probably due to its change in unpegging. And then we have the euro. So these currencies which are very overextended, those are the ones that I'm pretty curious about. The question would be how high can it go / how low can it go? So the Japanese yen is another curiosity, right? Very overextended. And over here, New Zealand dollar index, I would say not quite there yet. If we just look at candle price, there is still a little bit of space to go over here. So I think it's mainly like the euros, the euro and the yen is one currency that I'll be very curious about, right? And if we look at the dollar yen per se, I think for a lot of traders, we have been looking at dollar yen for I think since June till now. This dollar yen story has not ended yet. It's beat its historical data on TradingView, but if we go on other platforms like Yahoo Finance, etc., the last 30-year resistance would be at the 146 mark. We kind of broke that in the last 2 weeks. We hit just above 150. So of course, my next question is, with the US dollar expected to increase its interest rates next week to 4%, and the Japanese government, even though they did an official so-called intervention in September due to a bond transaction purchase, right? My question is, will they continue to intervene? Will they come in and say, okay, 150 yen is as low as we are willing to go in terms of its import-export parity, right? Because the more expensive the dollar is for the Japanese economy, it would mean that it will be more expensive to import in terms of whatever they're buying from the US. And not to forget, I think almost like 60, 70, even more % of the world's trade is actually invoiced in dollars, right? When you're dealing with international trade, a lot of these products, not just commodities, right? Even your, I think, daily products, manufacturing stuff, they're all invoiced or quoted in US dollars, just because US dollars is such a widely used currency. So if you now have a problem of if all your if you're doing international trade and everything is quoted in, priced in, or invoiced in the US dollars, how does this then affect companies who are dealing with supplies coming in from the US? Do they have to get creative about it? Do they have to find alternative imports? Like, do they have to go to China, or even figure out if there's a way to import from Russia illegally, etc., etc.? So I think policies are going to start to change back end in a lot of these countries, where a lot of countries, and I think we see the news as well, a lot of economies are trying to figure out, is there any other better currency to invoice in? So in the recent months, we have seen articles that are talking about, okay, let's invoice stuff in the euro, or between the China and Russia, they're already, I'm pretty sure they're already starting to transact between themselves, Russia / renminbi, or whatever it is. And we also have India jumping into the pot, right? India is now willing to pay in renminbi or willing to pay in less USD. So will this 4% increase, this 4% textbook increase, where hypothetically or theoretically you increase interest rates, it's supposed to give you some strength to the currency due to the interest rate differential, right? How long will this economic concept go when people are starting to feel a little bit unhappy, or they are starting to dislike the US dollar per se, right? But of course, until that sentiment changes into some kind of policy or fruition, we probably will see dollar strength, because if you don't really have a choice, you just have to transact in dollars, then you have to transact in dollars. So in conclusion to my very long-winded explanation, all right, is for the dollar yen, will we continue longing the dollar yen? So this is my dollar yen chart on the daily time frame. All right, we have a very nice strong resistance at a 146, and bearing in mind 146 is I will call it a 1998 resistance, right? If we go on like Yahoo Finance, you will see that 1998 price has actually rejected off this area in historical data. In terms of historical data, what it has done, it has given us, I'm going to quote Lloyd over here, it has given us quite Lloyd's a very happy break and retest. So my question is, or I'm pretty much hoping that this break and retest holds, and we will see another push to 150. And then when we reach 150, I guess we'll have to figure out whether or not the Japanese government is ready to change its policies, whether or not we will see them coming down and saying, okay, this is the limit, right? But if they don't change its policies, they are still going to sit tight on their low interest rates because I think their inflation numbers are not too bad. The inflation numbers are only at about let me see. I think the inflation numbers are still at a very controlled 3%. All right. So if we compare its 3% inflation across the board with its other counterparts, I would say 3% is higher than the pre-COVID 2+%. But if you compare it to your counterparts, they don't have to be so scared of inflation yet, because it is still only 3% as compared to the US, which is almost 3 times as small, the Euro, which is 3 times as small, UK, three plus times as small, etc. So in the spirit of that, I still do feel I would prefer to sit on yen shorts, but very cautiously as well, because we are in overextension. So very cautiously on yen shorts, all right, with the expectation that there might be some Japanese buying Japanese bond transaction to kind of prevent it from going too high. And for US dollars, it's very difficult to sell the dollars at this point, being one of the, I guess, being having the highest interest rates and being a little bit more aggressive in its policies. So I guess I'm entering in the period of, while I'm listening to the fundamentals, I have a huge eye on the technicals, because I think the technicals are where the sentiment currently is, where everybody is waiting for each other and seeing where they'll trade or where the candles will go. And then once we see a confirmation, we'll pile in. So I'm really looking forward to what Julian has to say today as well. Over to you, Geoff.
I'm getting the impression that in your view that there's no need to change anything just yet, but stand by.
Yeah, something like that. Stand by and and wait for that signal. I think now it's a lot of patience. We always say traders have to be patient. So this is one of the times where I think we shouldn't go rushing into a reversal or an extension trade, but it's really about be patient and watch out for that signal, so that once that signal comes, we are ready to take our entry, pile in the risk, and hit back up or down, depending on what that signal is. Yeah.
Cool, mate. Thank you very much indeed. I think that's wise advice most times, is it not?
Yeah.
All right. I think we've, thank you, Lexi. We'll catch up with you a little bit later on. Since we last spoke to Julian, I think he's cleared everything up and he can now talk to us and be heard, which is fantastic. G'day, mate. How you doing?
The absolute magic of changing the room that you've got your office into this morning, and then realising that the Wi-Fi wasn't quite working properly. So, hi folks, hello, and Lexi, a special hello to you as well too. So hopefully we can we can cover off a couple of the points that you've asked about. I'm going to start, and I hope everybody can see that chart in front of you there. Okay, it is a chart of the US Treasury bonds. So why are bonds, which some people view as possibly the most boring market on the planet, the most important? Well, it's the most important simply because they're the biggest in the world. Okay, interest rates dominate everything. Long-term interest rates tell us so much information. Geoff, small point, we get onto that, hopefully answering that question we were discussing earlier later on. So when we look at the chart, what is happening? This is a weekly chart of the US 30-year Treasury bond yield. And as you can see, as I'm staring across it, I will put my glasses on at this point, because then I can do it without looking a bit weird and going off screen to do it. As you can see, we have been in rally mode. So yields have been going up, prices have been falling. Perspective-wise, if you're a bond trader in any of the G7 markets this year, it has been a nightmare for you. It has simply been the worst year in the bond market since I've been in the business, and I've been in the business a very long time, back into the 1980s. There has not been a year like it. If you are this sad and unfortunate owner of 50-year gilts, you have lost 70% of the value. It begins to look a little bit like a tech stock some days. What does that mean? It means that interest rates, so as the price comes down, the interest rate goes up. So you've got a much higher interest rate today than you had 18 months ago. In fact, even less than that, even 9 months ago. A significantly higher interest rate. What does that mean? Well, if you think about it, when you look at the stock market in the States, we all know that the stock market in the States doesn't pay many dividends. There aren't many big dividend paying companies there, are there? It's all about growth. When we think about the NASDAQ, we think about growth, capital growth, the great idea, the new business. We know the story. Okay, so that has, if you think about it, because it doesn't pay you any money back. Okay, what you're relying on is the growth of that stock to go up and up and up. So the business idea to be incredibly successful, to do that usually requires money. When money is cheap, those stocks tend to do very, very well. Why? Because it's just obvious. You can borrow money cheaply and you can invest it in a great idea that then becomes a fantastic business idea, which then becomes a great, an amazing business idea. Think electric cars or perhaps Facebook, although there may be a few people that own Facebook who disagree with you this week. So the point about this is, as interest rates go up, those ideas become a little bit more tricky. Now we need additional performance, not worse performance. We need much better. We need the idea to be even better. Why? Because it costs more money to fund it. Okay, so that's why this long-term interest rate that you're seeing on the screen is absolutely critical. So as that goes, so will go the stock market and the equity markets in general and the investing environment. For those who are sitting here today in G7, I don't need to tell you about what's happening to house prices around the world or what's happening to some tech stocks around the world. We've all seen what's happened to Cathie Wood's ARK fund. It's lost like 90% of its value in the course of the last 12 months or so. Tech is dead, which it isn't, but at the moment it's not the right place to be, or hasn't been the right place to be. We'll think about that in a minute. So let's look at that bond market and see what's been going on. Look at the momentum. The momentum and the trend matched each other up until recently. This is a weekly chart. So if you go and think about what's been going on, as the yields have risen very quickly recently, in the US, what you've seen is that momentum start to diverge. Okay, now is that the sign of a top? Well, who knows? I can't tell you whether it's a sign of a top, but what I can tell you is that sentiment is appalling. Sentiment is appalling in the stock market. Sentiment is appalling when you pick up a newspaper and read about the housing market. Apparently it's about to collapse. Sentiment is appalling in the bond market. There's nothing but bearishness. Interest rates are going to go up forever. Okay, maybe short-term interest rates are going to rise a little bit. Central banks have got to fight this thing called inflation, because as we all know, despite the fact that every single piece of leading economic data is telling you that inflation is done and it's coming back to 4%, possibly 3%, I don't know, across the most jurisdictions reasonably quickly. Okay, what you're seeing is central banks who got it wrong at the beginning, who got it wrong when they started to raise interest rates because it was the wrong time. It almost like when they started to panic, the inflation almost just topped out at that exact moment. So when we look at the bond market, let's go and drill into it a little bit and try and look at some of the dailies and try and see what's been happening here. Okay, for the last 2 weeks, 10 days, okay, the bond market has started to behave a little better. So yields got to about 4.30 on the long bond, and now they're back to 4% I believe now. Yeah, about 4%. Closed below it on Thursday, came back a little bit on Friday. They closed below it on Thursday after like 5 straight days down in yield, up in price. Okay, for those of you that look at the TLT, which is the 30-year bond index or the 20-year bond index ETF in the States, you'll have seen that's gone from 170 to the mid-90s. Okay, that is wealth destruction on a grand scale. Does it represent value? Well, I can't tell you what's going to happen next. Nobody can. But what I can tell you is, as you look at this, okay, as those interest rates have started to come down, what's happened to stocks the past couple of weeks? What's happened to the dollar? What's happened to all of those assets that were trading in line with that rise in US interest rates. They've all come to a point where they've started to have a bounce of a kind. Lexi was talking about this, right? At some point, the sentiment gets so extreme that people just can't ever bring themselves to be involved in it again. And I really feel when you look at the headlines, we're seeing the sentiment extremes. I've talked about this over and over again. For those of you who have listened to me for the past 4 or 5 years, you've been incredibly patient. But the one thing I have said consistently all the way through this, if you walk back a year, I said sentiment in stocks was extreme to the top side. Unbelievable. We've never seen anything like it. Sentiment and a lot of other assets were sitting in the same place. Today, as we see this, bar one or two, this little bounce set we're having here, sentiment is the exact opposite in many parts of the stock market. If you're in the tech sector of the stock market, sentiment is an extreme low at the moment. Prices are at an unbelievable collapse compared to where they were. So is that interesting? Well, I always get interested when people are getting very, very, very negative about things. Why? Look, it's just sort of, to me, I see when crisis hits, that's when opportunity strikes, right? There's opportunities for you to be involved. When everybody else is buying, do you want to be buying? No, you want to be thinking about buying when everybody else is selling. You will not get the bottom price. It just is, you'd be lucky. Brilliant if you do. But the key thing here is identify that sentiment extreme, then go to your charts, then have a think about what that means, and then that will be the wind at your back of your trade. So when we talk about the anti-trend trade that Lexi was maybe alluding to a little earlier, when it's going to happen, I'm already seeing it starting. Okay, I'm already seeing it starting in stocks. I'm already seeing it starting in bonds. I believe we've made a turn. Does that mean to say that this is the end of the rally in yields? Well, I can't tell you that. It just begins to look like it. Next week, if the technical picture deteriorates, I may have a different view. But for the time being, what I'm seeing of those sentiment extremes is a potential reversal in the euro, a potential reversal in dollar yen, potential. And dollar yen's probably the weakest one of the lot, actually. I'll go into that in a second. When you look at the Swiss franc, when you look at the Aussie and the Kiwi, the Kiwi's got down, I think, to 55. The Aussie got down to the very low 60s. These are levels which are quite extreme from a sentiment perspective. Again, is it the low? I can't tell you. Is it a sentiment extreme? Are people particularly negative about those currency pairs? Yes, they are. So when you see an extreme in sentiment and you see a technical backup to your trade, then sometimes those trade reversals work. Why are they so attractive? They're attractive because on a risk reward basis, they've moved super quick, super fast, and super distance. Okay, we can look at what's happened to the euro. The euro, I believe, got down to, was it 95 on the low, guys? I can't remember the exact low point, somewhere around that. Where are we now? We got back to par even, right, to one even, almost in what, a week, 10 days, something like that. Okay, these reversals are there and they're great trading opportunities. So just have a think about that sentiment and where you want to pitch it. And for those of you that have missed out on this, just read a newspaper from time to time. Try and pick up this idea about how people are feeling. Go on Twitter. I just do a straw poll of 10 people on Twitter who comment on financial markets and see where they sit. Okay, when things are bleakest is the time when the opportunity is there. Okay. Right, that now having been said, let's dial into a couple of things. So what's happening at the moment? It's the end of the month, right? Well, does that make a difference? Well, in October, of course it does, because every October, from trading day 18 to trading day 22, the end of October, there is a 90% of the US stock market rallying, a 90% probability of the US stock market rallying. So what has happened? Let's go and look at the US stock market for the last few days. We'll kill the momentum chart. Let's just go look straight at this. Okay, here we go. This is day 18 here, I believe, or is it here? I can't remember which one. Look at what's happened the last 7 days, right? This is coming into month end. Okay, the market's up again, yet again. So this is almost a 97% chance now. When you go back and look at the previous 30 years of data, the market tends to rally at the end of October. Why? Can't tell you. I don't know. Who knows? Who cares? Okay, you're looking for 90% trades guys out there. Do you have that sort of success rate on your trading systems? Well, some people do, some people don't. Here's one that's been working for quite some time. This is out there in the market. There's lots of people talking about this. It's not as though it's unknown. Okay, so this is a known signal. There's another one coming up at the end of the year. Is this working at the moment? Well, quite clearly it is. Is it going to work on Monday? I can't tell you because I don't know when Monday's going to hit tomorrow. We'll all have a look. But when there's a bias for the market to rally, what does that do? At the same time as this, you've had a rally in those treasury bonds. The yields have fallen, price is up. Okay, so then the stock market has the wind at its back. So question, is this going to continue? Is this a dead cat bounce or is this something more serious? Well, here's the thing. We're walking into a Fed meeting next week. There was guaranteed 75 basis points if I walk back 7 days. Now, all of a sudden, the economy is starting to deteriorate. What I'm seeing now is people begin to talk about only 50 from the Fed. Or language after they raise 75 that they're going to start to back off. Imagine what the Fed starting to back off would do to asset markets generally. Imagine what people's attitudes are at the moment. With everybody being so negative, ask yourself this question. What are people's positions today? If they're so negative, would they be super long of stocks or would they be out of stocks? If they're so negative, will they be super long of bonds or will they be out of bonds? If they're super negative, will they be super long of the Aussie dollar or will they be out of the Aussie dollar and still in the US dollar? So imagine the sentiment shift on the back of a nuanced Fed speak. Doesn't have to be an action. It just has to, for him, has to say, but. That's all we need to hear next week. Okay. Geoff, I'll leave it there. I've taken too long already. Any questions that anybody has?
Mate, I'll wait on those questions most certainly, but love it when you talk like this. This is my kind of season, if you like, when those markets are looking to turn. And I think we've got a common theme here already. Alexis has touched on it. You've followed through. And let's see if that pans out in the next week.
Yeah. Hey, so. Thanks, Geoff. Hey, look, one quick thing. Am I allowed to do a little 2 seconds more here?
Of course.
Okay, right. Dollar yen. Lexi, dollar yen. Right. Now, when you look at this chart, okay, this goes back to, I don't know, I've got 82 on my chart, right? So it goes back a few years, right? I also looked at the British pound for the record as well too, and I remember the last time it was trading at these levels, and then I looked at the date, so I didn't put that chart up because I'm not going to tell you how old I am. So anyway, right, when we go through this, okay, something I want you guys to bear in mind, right? Here is the chart of. Oh, don't do that. Hang on. Let me just see if I can just grab this line. This is the chart of dollar yen. And my mouse is not going to behave. Here we go. Right. I'm going to do this. That distance there, in terms of price, was done in terms of time. Perfect wave one. If anybody's into Elliott wave, you'll know what I mean. So perfect wave one, wave two. Okay, so price and time equaled each other. Okay, now we're in something different. For those of you that think about the sentiment cycle and the way we look at it, I'm going to pose something here. Are we at the breakout point? Have we reached the aversion point down here in this area where my mouse is? Let's try and make some colors down here. Well, let's just put a straight line on this. There we go. This area here. Was that the aversion point, right, for dollar yen? In which case, if it is, where's dollar yen going to? Because to me, it looks like an accelerating chart. By the way, for the record, guys, this is a quarterly chart. Okay, a quarterly chart. So in actual fact, if you've been dollar yen, you can be long of dollar yen for almost 2 years. Right, but this to me looks like an acceleration. It doesn't look to me like a market that's going to top out here. Could be wrong because it's a quarterly chart. Okay, I could be wrong, But from a technical perspective, when I look at this, my old friend, I did say this about 5, possibly 10 years ago. Ainslie will be able to prove me right on this, that it was going to 250, and it was a standing joke between her and me that she kept on saying, how's your 250 looking, for years and years and years. Funnily enough, laughing less now, not at my level yet, but it took a little while for me to get coffee up to where I wanted it to be. Anyway, so that I see when I look at dollar yen, trouble ahead. I'm not quite sure why it would ever go any higher than where it is now. It's already pretty weak on a year-on-year basis. So is it done? Quite possibly for the year, I don't know. And there may be something on the daily patterns that you can pull out, Lexi, that I'm not seeing. But I think there's a potential top in there, but it's got to be proven. And even if it is how long is it going to last for? Because this to me looks like a pretty accelerating curve. Something has to break. If the Japanese will not break their bond market, then the currency is going to break. Okay, so, trading wise, for those of you who are thinking about this, there's a short JGBs, long dollar yen thing going on here, right? And you choose your poison, right? Who's gonna blink first, the government or the foreign exchange market? So I don't know. There's something in there, right? And I don't advise people on what trades to do, but you get the hang of what I'm thinking. So when I look at this to me looks like it's got a little bit further to go. If that was a genuine wave 1, wave 2, then wave 3 is going to be a little bit bigger. We're on our way, believe it or not, we're on our way to north of 200. I don't quite know what's going to cause that, but crikey, that sort of suggests something quite serious. But anyway, we won't talk about that now because that's not for today. But so I hope that helped you on you asked me about dollar yen. So, okay, cool. Right.
Mate, that does certainly look like a chart I've seen 100,000 times before, especially when you do one of your presentations, I've got to say. But if we're on the yen, and look, I know we've got people waiting to go, but we don't get to see you often, so let's take advantage of that. I was asked a question by a mate of mine, speaking about the yen, and he asked me if Japan's debt to GDP ratio is 230%, which it is, and the US debt to GDP ratio is about 120%-ish, around there somewhere. How is it that the US inflation is circa 10% and Japan's is circa 3%? I won't tell you what my answer was. I'd much prefer to hear yours.
Yeah, I love it when you pose these questions to me, Geoff. So, okay, context, right? For everybody who doesn't know about what debt to GDP ratios are, this is the amount of debt that the country has versus the amount of GDP, so the amount of its economy, the amount of value its economy has every single year. So a so-called normal in a standard debt environment would be somewhere between 30 and 80. At 120, you can make a decision that probably you borrow quite a lot of money. At 260, you can make a determination that you've borrowed so much you don't know what to do. So they have a decision point in Japan. But why isn't inflation feeding through? Well, Japan has a demographic problem. It has a deflation problem. And all that's happened recently is that one sector of the economy isn't performing that well from an inflation perspective, which is the cost of energy, right? That's a worldwide problem. And for those of you that haven't read a newspaper in the last 4 months, please go and look it up. There may be something going on in the energy markets. I'm sure you're aware. You don't need me to rehash that, right? Complete carnage and remarkable times for that sector. So what is going on in Japan is that they've isolated themselves for a lot of the inflationary effects because they have not been as expansionary from a fiscal perspective as the Americans have. So what the Americans have done, somebody described it to me the other day. They said if you look at the combination of fiscal and monetary policy that the Americans enacted during COVID and put really in 2021 with various pieces of government legislation, they've actually done something which is 5 times more expansionist than any other previous economic time that they've been in. Okay, so that means to say the combination of the policies have essentially generated 5 times as much, not growth, but 5 times as much activity in the economy as they've ever had before under any previous government since the Second World War. So think about it as an extraordinary accommodation. Is it a surprise, therefore, that inflation's up, that nobody could get hold of anything, that goods volumes are through the roof? And we've then had all the consequent problems that have happened because of that. And now we've got the opposite. Now everybody's bought everything. Now there's no more government support and they're raising interest rates. What do you think's happening, right? So you take that 5 times expansionist policy and then you collapse it in the space of 12 months. What do you think is going to happen? Funnily enough, underlying the economy is a lot of inventory overhang, and already you're beginning to see deflation, a lot of commodity markets and all that other thing. So the key point is that's why the US inflation was driven higher. It's a lagging indicator, inflation. It's lagging and sticky, and that's why it got driven higher, because Japan just didn't expand as much. And because of the way that their economy is managed, and they're thinking about, so think about this, right? They always have a deflationary impact of about 2 or 3% every single year as an overhang. For them to get to 3% inflation is awesome, right? But they've got to it the wrong way. They've got to it through energy price increases, which doesn't make anybody any richer. It actually is more disruptive. So I hope that helps answers your question, Geoff. One little addendum on the end of this that I will say is that it doesn't matter what your debt to GDP ratio is. What really matters is the shape of your yield curve with a debt to GDP ratio. What matters is whether you can finance this stuff, right? So if nobody believes you, right, then that yield curve steepens. Okay, long bonds yield a lot more than the front end. At that point in time, then you have a problem. Until that happens, the world is fine. Borrow as much as you want.
Including borrowing more to pay your debt, right? Which is what the US
exactly. Well, I believe most of the JGBs in the world are now held by the Japanese central bank.
Interesting. More than interesting, mate. That wasn't my answer, of course. Mine was far more abridged and less information in that. But thank you very much. Really appreciate it. My mate will be very, very happy. You've got a course coming up next week for those in the mentorship group who are eligible.
I have, yeah.
I urge you to attend. What's it about, Jules?
So we're going to cover quite a few topics, actually. In fact, I'm going to be interactive. For those of you who are in the eligibility category, you will get an email from James, I think tomorrow. James and I are working on that script tonight. And I'm going to ask you what your favourite 5 topics are, and we're going to go through it. So it's almost going to be like a Bruce Springsteen concert. We're going to stand there and you're going to ask me what you want me to talk about, and I'll talk about it. There's about 7 or 8 topics, and you're going to get the best 5. So what I want to try and do is whatever's focused to what you think is your biggest problem, your biggest opportunity in trading that you need help with at the moment. And we'll go through it. The one thing I won't be doing is telling you what to do and when, right? This is about you developing as a trader. What are the tools you need to develop as a trader, and how can I make you better as a trader and go on to be profitable and successful? And I'll hopefully see you guys next Sunday.
We'll be headlining all the traders turning up at Bali. Again, if you're in that mentorship pathway and eligible to go to Bali, be there. Just be there. That's all I can say. Julian, thank you so much for your time, mate. Really appreciate it. And we'll catch up later, eh?
No worries. Cheers, guys.
See you, mate. All right, waiting patiently in the wings, of course. I know he has to go, and I'm sorry, mate, to hold you up. Lloyd, how you doing?
Hey, Geoff. Right, so let me, without further ado, jump to my trading view. Oh,
I won't ask you any questions, so I'll just let you go.
Right, thank you, Geoff. All right, okay, let me grab the screen. Okay, mine is actually a rather simplistic view on the market. I always prefer simple stuff, easier for my simple brain to work with. Now, top of my list is actually the Kiwi index. So you can see that the Kiwi index has been bouncing off this very nice level. Yeah, almost like a double bottom already. Just that it has not really break off any levels yet. So for a short-term play for the hourly and 4-hour chart, we can actually make use of this. So we do have about some movement that before price reach a very, very strong horizontal level at $60. Yeah, so there are some movement that easily can give us 2 to 3 to 1. So this is, I have to admit that the past 2 months is actually rather tough to trade. Now, so I don't really like to, in lieu of that, I don't really like to go for those huge risk to reward. But this is definitely in play for now. Kiwi looks to be the strongest on my chart. Now, the next on my chart, which is the pound index, which has really ridiculous price drop. Other than that, it seems to be dipping above the previous strong level, 115, and then going above it. Now, I'm not too optimistic about this pair, just that it appears to be the second strongest on my chart. What I'm patiently waiting for is that, I'm on a weekly chart, by the way. that the pound index will actually retest this 115 before it actually shoots up again. So it's basically just another break and retest. Yeah. So the Kiwi and the pound will be the strongest for me to trade. Now, on the other hand, the dollar index, I'm actually gonna be staying out of it for a while because it has been fluctuating between 114 and 1104. I would say the last 5 weeks. Yeah, it is not actually showing any clear direction where it wants to go. Yeah. On saying that, it has just last week tested 110, so it might very well be a bounce. Yeah, but seeing that the overall picture really paints it is in the range, so I don't really want to touch it. Now the Swiss index, again, this is a really messy chart. You can see two high test bar on both sides. So usually when I see such price action, I tend to stay out. Not a very clear direction where it wants to go. Moreover, when you see 110 in the past, this is really a messy place to be. I rather wait for price to clear this area before I jump in. Japanese yen index, you can see that it's really dropping. It seems that it wants to recover, but there isn't really showing much strength in the price action. So against Swiss and yen, I rather stay up for a time being. Now the Aussie index and the yen index actually displaying very similar outlook. Yeah. So again, this is not a price action whereby on the currency index that is looking favorable to trade short. Now, definitely the overall index to trade short, but just not this. And on top of that, it's not bouncing off any levels. Now the European index will actually be a really clear-cut downtrend. On top of that, recently it tested, just last week, not recently, last week it tested the $100 level. So I'm really waiting for some bearish price action to come in on Monday, and then I'll be set to go in. And the weakest on my chart would be the Canadian index. You can see this level very nice. It actually retested this level over a bit, come back up, and retested a second time. Again, this is a weekly chart, so it took a month for the price to do this. So that seems to be very good levels to trade off. As such, what I'm keeping a lookout for next week is actually Kiwi CAD. You can see that on the 4-hour chart, it already has some semblance of an uptrend, consolidation. The surer way to trade will actually be waiting for price to break the previous high, retest, and for it to go. Now, testing you can see that if price actually consolidate and there's actually a very nice low test bar coming in, a very nice rejection of this level, this would be a riskier trade, but will provide a better risk to reward. Yeah, so there's really two ways to trade this, but both definitely to go long. And then Euro Pound. Not a very strong downtrend. In fact, I would say that this is really some messy consolidation. But if price do ever break down from this level or break and retest, I would say that we will be in a very nice journey downwards. Yeah. So these are the two charts whereby I'll be keeping a lookout for the rest of the week. So that's all for me, Geoff.
Awesome, Lloyd. Thank you very much, mate. You're going to Bali. Enjoy that. I'm so sorry I won't be there to have a refreshment with you, but have a great time.
Thank you, Geoff. I'll be missing you.
I'm sure you will. All right, let's go now to South Africa, I think. Yes, we will, where our 5-minute master, George, awaits us. Let's see what he's thinking for the week ahead.
Good day, traders. Welcome to TTR. My name is George, for those who don't know me. And I host the live Trading Profits show every single Wednesday, and presently running at 6:30 p.m. Singapore time for 45 minutes. I also host the Wednesdays at the Market Show private group for subscribers to the year-long coaching on the 3rd and 4th Wednesdays of the month. I just thought today I would talk about levels of support and resistance, which give me a sense of the higher probability direction of the market. And just to start off, we can start off with Hang Seng 50. Actually, my favorite stock indexes to trade. Absolutely love this market, and primarily because of its 3 distinct sessions. You know, when it opens off in the morning, 9:15 a.m., closes for an hour, then opens again an hour later, then closes again in the afternoon for 45 minutes and opens once again to the end of the day. So distinct opportunities there. Presently, this thick blue line is the low of 2022, And we got to that by this massive bear candle here, which was on the 24th of October. Now, what's interesting about this is we just have a quick look to the left where we are coming from. Earlier on in the year, we had this massive sell-off, and we spoke at length about this in Live Trading Profits. I think it's probably over 100 recorded sessions now, or that you can go back and look at. In this period, we kept speaking about the sell-off. And I remember at this time we were saying, well, if the bears are strong enough to break beneath this trading range, that's where they're likely to go. Did not seem possible, but that's where we absolutely got to. Now, what is interesting about that and talking about measured moves, two types of measured moves that every trader actually has to become familiar with, whether you trade price action or not, like I do. One measured move is simply when you look at the length of a breakout, like we had this breakout here, you expect that the market to get to a measured move at some stage. We had that breakout there, and I was talking about measured moves that the bears want to get down to here. But when all this pullback, kind of thought like it's impossible to get. I mean, this took place in February, March, but we got there, 8-9 months later, the market got to that perfect measured move. Even if you just look here, height of that trading range, and we're talking to say, listen, if we break beneath here at some point when you're up there, the bears want to get down to the measured move, and they got to the measured move. Another measured move is the leg 1 equals leg 2 extension, where you look at the first leg of any trend, it could be a bear trend or bull trend, in this case, bear trend, and you look at the pullback. If you do a first leg using your Fib expansion tool, the pullback to the end of the pullback, it will show you where the market is likely to go. Now, if you just have a look at this measured move tool here, if you just move it around for you, you can see exactly where the market wanted to go, and the market got to that with precision with this breakout here. So the measured moves from the leg 1 pullback, leg 2, the market has got to that. The measured move from that breakout, the market has got to that. But we have another trading range created here, another breakout potential. So as far as the bears are concerned, they keep saying, well, if we break out beneath this particular low, so this high, that low, we want to get to a measured move. And the measured move is down there. What this suggests is that there's still a little bit more bad news to come for the Hang Seng stock market. Higher probability event based on the price action. Higher probability event means there's plus or minus 60% chance of the market going that direction. That gives you sufficient room for you to make a decision to follow the market and manage your trades, of course, if the other 40% probability happens. So the market reached this cluster of levels of resistance, and there's still this measured move to get down here. Something else, which I can just put it in for us, that breakout, very strong breakout beneath a tight bear channel. Now the bears seeing that, they say, we're broken beneath the channel, got a pullback, and what we want to do, at least as far as bears are concerned, is just get to the measured move of that breakout candle. So that corresponds almost with the measured move of this. So bears, we have been selling all through here and adding their positions. I just want to, wait to see if we get down here. Of course, they manage their stops cleverly to technical levels. So if you get a reversal like one of those, if they've tightened the stops, they don't lose money. But it seems to suggest that there is a goal for the market to go. Now, something else, these measured moves are hidden levels of resistance and support, which you have to put in so you can see where the market is likely to go. There's other levels of resistance support that as a trader you need to be wary of or be aware of. These are simply big round numbers. Anytime you look at your price index on this side, whenever you see a big round number, you expect that to be a level of support or resistance. So at some point, this big round number, 16,000, was a big level as far as the Hang Seng 50 was concerned. And we got down before all of this took place, had a pretty, let me move this out of the way. So that measures the height of that bear breakout candle. We had a decent reversal setup for the bears, double bottom at the bottom of a tight channel for the bulls rather. And all the bulls needed to do was to, I'm sure many bulls put their orders up here because it's a perfect setup. Put an order up here and you can do a major move. Stop somewhere down here and your goal is to get to the test of the 20 EMA or the top of the channel line where you can expect bears to come back in. But the market gapped down and sold off. So the bears were very strong to prevent that setting up. So the bears are strong, small tail, new low. And you can see the pullback by the bulls very weak, only tested the low of that breakout channel, followed through next day good. But then we have a perfect enough setup of the descent in 10 EMA, which I use to indicate the strength of a trend and continuation. So double bottom at the bottom, at the low of 2022, the probability favors the bears at least to make a little bit more move down there. So key levels of resistance and support are the structural levels, horizontal levels you can see, the hidden levels of support and resistance. And these channels, whenever you see a channel, stick it in because market breaks above it, comes back to test, tries to break above it, and you can absolutely see that. So this blue line is part of the measured move I showed you earlier on. So just very quickly bearing that concept in mind, if you ever look at the euro versus the dollar, I mean, look at what's happened for a long time. This whole year we've been in a very strong, in a persistent bear channel, which is now a very strong bear channel. Every time the market tried to break out above it, it failed until we got into August, tried to break above, micro double top, failed. Try the same thing again off the same channel in September. Beginning of October, strong two-bar reversal. So the bears have been defending that channel line of the strong channel they've been in until a few days ago we had a strong breakout, and I expressed my concern about breaking above a tight trading range and saying that any breakout above the trading range is going to fail. You can expect it to fail. And where did the market get up to? Let's have a look at this. So the market gets, so the break above this, very good, but they have a problem with this big round number, 1, parity. Euro is equal to the US. Euro, dollar, the currencies are the same, parity. Euro is equal to the dollar. I mean, that is a big deal for anyone, not just traders, the ordinary guy in the street, whether you're on European economic zone or you are in the US, bankers, traders, everyone is watching parity. Okay, the market has to do something decisive. So having seen that, and of course coming out, breaking out above the trading range, breaking out above the channel, you have to expect most breakouts fail. Okay, and this in any case was not a strong breakout. We're breaking above the channel line, but we're not breaking out above the high of October, this strong two-bar reversal. We had to break out above it, which we did. But in breaking out above that, we broke out above a slightly shallower trend line. Fantastic. Broke out above that lower high, above that micro double top. Didn't get to the beginning of the bear channel, but then the breakout failed. That's why we say, looking at price action, you need to see a natural breakout candle and see follow through. So failed. It is not a surprise that they failed there. If you look at everything that I'm talking about for levels of support and resistance. Now, the market is still bearish from a price action perspective because all this is really becomes a higher high double top or double top here or lower high double top. What the bulls need to do is work a little bit harder. They need to reverse the two-bar reversal, get above parity, do a bit of follow through, break above this level, break above this level, then we can start talking of pullbacks. Until then, as long as we have distinct lower highs, the market is still bearish. Bears failed to capitalize yesterday. They ought to have at least given us a strong candle, so that creates indecision in the market going to the last day on Monday, but the market is bearish as far as I can see it. And just want to quickly show you before I move away from that. Let's look at that parity. We see that parity, we probably need, let's go up to the monthly. I mean, based on my charts that my broker gives me, we were last at parity in 2001. So I mean, this is 20 years ago. So this is a big deal. I mean, you really can expect that if we break out of this, whether we're going lower, which is what the price action indicates this is a monthly chart. So very strong breakout this whole year. And even if you get any pullback because of the strength of this breakout on the monthly, you can expect the pullback to the brief. And the market wants to do a measured move. Now, if you look on the monthly, it's even a little bit more interesting in terms of how far potentially this sell-off can go. All the way through from the beginning of the year, we haven't had a single candle closing above the previous year. In May, June, there was the opportunity, but we didn't. It was all lower high. So we still have to get a pullback. So you can make a guess any way you want. So that's leg one. Okay, so let's assume after that first leg, let's give the bulls benefit of the doubt. Let's say they can pull back. They can pull back to test that level. Okay, let's say the bulls can do that. Still suggest that the price still has to go down to this level, the 0.88 level. Now, I've just put that there, but it corresponds to the breakout. If you look at the high of this trading range, which was in 2021, and this low in 2020, just this trading range, the measured move is spot on there. So you could predict to say any pullback is only going to go that far, no matter how long it takes. So there is still a bit of bear news coming up. Now, what does it take for us to get to, on my charts, the all-time low? Well, all it needs is exactly where we're at. Okay, so if the market tends somewhere within here into the end of the year, they want to get to the all-time low. So just some thoughts in terms of measured moves. You can apply this same thinking, and for the purpose of time, I'm not going to do that, to S&P 500. You can see where we're at. Good for the bulls here, but there's clusters of resistance that they need to get through here. And the big one, of course, is big round number of 4,000. That's going to be defended. And lastly, you can have a look at UK 100, big round number 7,000. Market is oscillating around that. So I just thought, we could share a little on levels of support and resistance. Hidden levels of support and resistance being the measured move tool and the leg one, leg two extension tool, structural levels that you can see, the big round numbers, and of course, anything you see on channels going up or channels going down. All right, guys, take care.
Okay, that was George. Terminated just a little bit rapidly, one would have to say. There he goes. He will, of course, be back at the times that he mentioned, and if you can catch him then on the Wednesdays, happy days. If you can't, then he is one of our trading buddies, Ash and myself, conducting, of course, trading buddies each and every Monday and Thursday at the new time, I hasten to add, of, well, not new time for the UK, because the UK go off daylight saving as of today. And for those of us in Australia and Hong Kong, Singapore, we will have to go 1 hour later. So 6:30, that's for George, 6:30 Singapore time, I think, on Wednesdays. Trading Buddies is at now 5 to 7 here in Australia, which makes it 5 to 4 in Singapore and Hong Kong. So 15:55, if you like, for Trading Buddies tomorrow and Thursday. All right. I hope she's not asleep up there in Sydney. She's been very, very patient throughout the show and waiting. And here she comes now, Lenka. Hi, Lenka. What's going on in your world?
Hi, Geoff. Hi, all. Yeah, so I'm looking at two currency pairs this week. Let me just share my screen. Cool. Okay. So the first one I'm looking at is Euro USD. On the monthly, we are at this previous level of resistance, then became support. So I'm looking at that as the level of support. In terms of the candle price, it's indecision because we have the inside bar. On the weekly, I've got my little channel there that has been respected many times before. And now I've got a green candle close just above. Daily, I have 2 closes above with a pullback. So what I'm looking for here on the 4-hour time frame is a little bit more pullback to the top of the channel, or to the monthly or weekly pivots, which will be a little bit higher probably tomorrow as the market opens, and looking for a long opportunity at that point. If the price does not bounce off those areas and goes underneath back into that channel, then I would be looking for short again, as per the channel previously. The next currency pair I'm looking at is USD CAD, and USD CAD here I'm looking at short. So what I'm seeing here on the monthly, having 2 false breaks of that area. Now, we have not had a false break on this occasion, just a sort of, push off that area. So ideally, it would be better if that price was above and then came below. But on the weekly, we have a little bit of an indecision. So it's now going in that range sideways. Daily, we have a little trend going downward. So if I would see the price action at the top of that, I would be looking for short at that point. So on the 4-hourly, for the actual setup, we have a high, a low, a lower high, a lower low. So now I'm looking for that price to go a little bit further up and to see if it would get to the top of that trend line, or to the weekly pivot, which will be a little bit lower as the market opens on Monday. So and then looking for a push away from that area and a reversal. If that would happen, then I would be looking for a short opportunity on the USD CAD. And that's all from me, Geoff.
Cheers, Lenka. Certainly that is one of the pairs I will be hunting when that dollar does turn around. That's dollar CAD short. Do like the idea. Absolutely. Where we are, we're going to Salvador now. We've been halfway around the world. Let's go the distance and go to Salvador now, where, as usual, we'll say hello to the deepest voice in trading, the Big O.
All right, traders, how are you, Trader O here? Why don't we talk about the US dollar, right? So a big week ahead. On Tuesday, we have the federal funds rate decision, and it is expected that the Federal Reserve will hike interest rates by 75 basis points to 4%, right? Hiking interest rates, of course, bullish for the currency, and I have been bullish on the US dollar for a while now. I have been trying to buy dips, and the reason that I haven't traded the USD for a couple of weeks now is because of this range, right? This choppy range. We're looking at the 4-hour chart on the DXY, and this choppy range was extremely unprofitable to trade, right? Now, I wasn't going to trade the downside on the USD because if you look at historic price action or past price action, the impulsive moves are to the upside. So why would I want to trade a choppy pullback in a very bullish market? Now, having said that, I am looking for further upside on the USD. Now, also, the reason why I wasn't looking for trades at the highs is because going low at the highs of the moves when there's a ton of lack of bullish momentum and price creating new lower highs is also unprofitable in the long term, right? Now, what I saw last week, at the end of last week, is the US dollar breaking with these previous lows, and most importantly, with these previous lows, right? Now, this this, my friends, is extremely, extremely bullish to me. And let me explain to you why. So basically what I'm looking at here, let's go to the 5 hour chart. There's absolutely no reason why I'm going to the 5 hour chart. This is just to have the entire historic price action in front of our eyes, right? So basically what I'm looking at here is this. This, my friends, is just liquidity, sell side liquidity being taken out, right? Now, this by itself does not mean we have a reversal and we should be buying the US dollar because the current or the immediate structure on this market is still bearish. But also what I saw is this, right? Price reacting to this level of demand. Now, why do I know that this is a level of demand? Let me show you, right? I just plug my volume right here. Well, I can't plug it here because there's no volume on the uh, financial product that I'm looking at right now, but there is accumulation of buy volume within this range, actually here, right? Now, and that accumulation of buying volume created that break of the structure, right? A break of the previous highs. Now, the first flag for looking for longs next week is this, right? The bear trap at that liquidity sweep, then price reacting to this level of demand, right? And also, if you look at historic price action, we also have a very important key pivotal level in historic price action, right? Here is where we saw sellers jump in and where we saw buyers unable to swipe all the sell orders that were in place here. And then this is where we saw that accumulation of buy orders to move price up in the US dollar for about 5%, right? So, what I'm looking at next week, right? I'm looking for buys on the USD. This by no means, I don't have a setup at the moment, but everything is pointing out at possible buys. So if we look at the hourly chart in this market, right, the immediate structure is still very much bearish, right? Price creating lower highs and buyers unable to break with these lows. Now, let me just delete this to be a little more accurate in my levels. Now, the level that I would be looking for, there's two scenarios, right? Let me just delete this. There's two scenarios, right? Should the DXY open lower, I will be looking for buys at, I'm sorry, at the previous lower time frame area of demand. So if you notice here, what happened is that we saw the last break of the structure to the downside. Let me just rub my brush here. The last break of the structure to the downside here, then this should mean a break or a change in the character of this market, right? Now, most often than not, right, weak longs or weak buyers in the market are going to get stopped out before price continues to the upside. Should it continue to the upside, and this liquidity sweep in the market creates a very, very interesting and potential high probability longs at the area of demand that created that break of the structure, right? So the first probability, or I'm sorry, the first scenario would be a deep buy towards the 110. But if this market opens very bullish, right, and opens above the 111.50 and holds this level, this is where I will be looking for longs again. And as you know, I'm only looking for longs in this market. And after Friday's bearish breakout, taking out all the deep buyers or all the weak players in the market that were trying to um, catch the move at the highs, I think the probability of this dip buy is quite good. Now, should price or should the US dollar open lower, or should the US dollar open wherever it opens, right? But continue to continues to break with the lows, that would mean that the pullback structure is still very much in play. That's why at the moment there is no setup, because either price would break with the lows, which would mean that the pullback or bearish pullback in this case, right, is still in play, or we will find that dip buy, which will mean that we are right about the pullback being over. So stay safe and see you around.
There you go. That's the big O. And as always, focusing on the US dollar, as a lot of us have been doing this day. I'm going to be a little bit different with my summation of what I'm looking for this week. And first up, I'm going to look at what I looked at last week, which was the euro versus the Kiwi. And that was my trade of the week last week, coming off the top of this broadening pattern. And we had to wait for a higher low. It turned up very, very quickly on the Monday, as a matter of fact, and hopefully some of you got into that short down to the monthly pivot. What happens next? Well, I think that's a pretty beautiful sign of a reversal for me. It's a double top followed by a lower high. Problem you've got now is you're sitting bang on the monthly pivot. It's going to be the last day of the month tomorrow. That may throw a spanner in the works as far as continuation is concerned. I wouldn't want to be picking that up here anyway, so I'd much rather see it pull back to the trend line one more time, maybe even give us a false break of that trend line, and maybe even monthly pivot won't be there on Tuesday, of course. So that won't be reliable, but this trend line will. So I'll be looking for a false break off that come maybe Wednesday, Thursday, thereabouts. That's Euro Kiwi. Only two others on my watch list for the week, and one is Pound Aussie. Now, Pound Aussie's a suggestion from this chart that it is at a resistance level. Probably put that trend line in through there. You can see that it's come back to here and tested or retested the backside of that trend line. I'm suggesting that we get a little bit of a bounce off that. So I'd be looking to trade that short at some stage. That's the monthly chart I'm looking at, mind you. So we won't be trading it off there. What we will be doing is carrying that bias into the week. So if price can't get above this high in particular, then I'd be looking for price to come down, maybe give us a false break of resistance at some stage, if that is indeed to become resistance. But we do have a reversal bar there in this high test bar. That's giving me the license to go short if I get a lower high. So if this becomes a lower high, any price action off that trend line would be interesting for a short. But it's not the one I'm favouring. The one I'm favouring out of the pound pairs, once again going back to the Kiwi, and I was interested to see Lloyd's appraisal of the Kiwi, suggesting that it's going to be strong this week. But I think he also threw the pound in there as well. I'm a fan of the Kiwi this week, and I will be looking for a short on pound Kiwi. Really based on the top of the range at the end of the day. And if I point that out very, very quickly, I don't want to hold you up too much longer, guys. It's been a very long show today, but it's a bit of a bonus one because it's our fifth one of the month. I can see this range in here, and maybe it's a little bit tighter there, which makes it very, very close to the top of last month's bar. If I now go to the smaller time frames, we'll start with the weekly. The weekly showing me a big reversal bar there 2 weeks ago. Then it's given me an inside bar. That's a pattern that I don't mind at all, as long as I'm trading with context. Context here, to my mind, that's now out of context, is that we're coming off the top of that range. And I would prefer to see much more time have passed to give me the lower high. But game changer bar, I call those, followed by an inside bar, does give me the idea that we're going short here. So a short underneath that bar makes sense. Stop loss above it. If it triggers that fast as tomorrow, then you want to be taking profit at the monthly pivot. The monthly pivot's going to be up here somewhere come Tuesday. So that may change things just a little bit in terms of a support level. Not suggesting that we need to go short right now. I think these are definitely pointers, directional pointers. And for that reason, I'd be willing to trade anything off resistance up here on the smaller time frames. And right now, that's almost a scenario that I like. So price, if it could break through here, come back underneath and retest that level, then I'd be willing to trade it short. So it's pound Kiwi, euro Kiwi, both short from me, pound Aussie following up. But we do have Aussie news, of course, on Tuesday. That will be the interest rate announcement and the RBA statement. And of course, on Wednesday, Thursday, that will be a bit of a super challenge as well, because we've got the BOE and the Fed doing exactly the same thing as the Aussie. So it's a big week in terms of interest rate announcements. If you can get in the market and get free trading before they happen, you've probably got a very good chance of winning some dough. I'm hoping that that will be the case for myself. My thanks to all the presenters for today. It's been a long one, guys, but it's a bit of a bonus, as I said, with the 5th week of the month. And we like to bring as many traders into the room as possible. We hope you've enjoyed it, got something out of it, and we look forward to your company when we do it all again next Sunday. Have a wonderful rest of your Sunday. Bye-bye.